Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Boy, it is a pleasure today to have Dylan Borland with Borland Capital Partners today. Welcome to the show, Dylan. Thank you for taking time today.
Yeah, thank you. Don't speak of me too highly because I don't want to disappoint, okay?
No, you being humble, Dylan, so I appreciate your time.
Having me on your show for sure.
Absolutely. So for our viewers and listeners, Dylan is with Borland Capital Partners. He's the chairman and CEO of the company. It is a private family office and a large private real estate equity player today. Since 2006, Dylan has invested well over into 2,700 units and placed well over $180 million. He has a large background into doing real estate single-family homes, which he exited and has come in a big way. And he's a very good mindset guy, understanding what it takes, the mind shift to kind of come into multifamily and the sort of the mindset someone has to adopt to go bigger, better. So thank you, Dylan. I appreciate your time. Kindly share with the listeners and help us get started about your background and kind of what things are happening at your company today.
How far back do you want to go?
Let's start with the real estate career. How's that?
Well, I got into real estate. Most people that know me know this. I got into real estate at a really young age. I was 17, actually. Mm-hmm. And I had to have my girlfriend at the time buy my first property because she was of legal age.
Sure.
And I started there because I was fix and flipping cars, and I wanted to figure out, what could I fix and flip? And naturally, I gravitated towards real estate.
Sure.
So like you had mentioned earlier, I started that in 2006 was really kind of when I officially launched my business. Mm-hmm. And that was 2 years out of high school. Oh my goodness. I just now realized that. So, I started with fix and flipping, which is something I was very, very passionate about, the single family space. I did that up until about 2014. Mm-hmm. As you and I had talked ahead of the show.
Sure.
My specialty really was foreclosures. Fix and flipping properties. We did about 120 properties a year here in Metro Detroit, like clockwork. I'm a very systematic person. We use systems and processes to do everything. So, and then I, developed during that time a single family portfolio of 108 single family properties as well.
Sure.
And then I got very, very complacent in my life. I through real estate. One of my original reasons in real estate was to hit a very specific cash flow. I just thought, gosh, if I could do 100,000 a year, that would be great. And then very quickly you get there, right? And then I say, gosh, if I could do $1 million a year, which is something I never thought I would do in my life, then, I didn't think that would be possible. And then I got there.
Sure.
And then I was lost for a while and I just got very, very complacent. And it wasn't until I had a partner, this was like 2013-ish, who was diving into multifamily. Well, he's a friend. He was part of the same coaching program I was in.
Sure.
And he started doing multifamilies, and he had a property in Minnesota. He had a property down in Florida in Ocala. And he said, why don't you just come in, dive your feet. I need a partner. We go 50-50, dive your feet on these properties. And I said, all right, sure, I'll dive in. And the properties did very, very well. I had very limited participation in them. We sold them. Made a lot of money, and I never thought of it again. Like I said, I was very complacent in single family. I was comfortable. I could do it in my sleep. And then just something happened where I just got like super burnt out from just, I went through a divorce early on, and I had actually, and we didn't talk about this. Why did I sell my single family? Other than it caused the most stress in my life. I went through a divorce. I had to sell that entire portfolio. So I lost all that cash flow. So then every day I had to wake up and figure out, to keep this machine going, what was
Sure.
a house I was going to fix and flip every single day? I just got
Sure.
really, really burnt out. So make a long story short, I said, wow, well, let me go back to, multifamily. And if I'm going to rebuild my cash flow portfolio, I don't want this. For me, it was actually very stressful.
Sure.
And not everybody has that same opinion. Some people really like yourself. You really like single family portfolios. I didn't like it.
Sure, sure. No, and I think there's something to be said, Dylan, as well, right? Things done right, right?
Yeah.
And obviously, I'm at a
Yeah.
phase where basically all the acquisitions are done, and it's kind of a moving, pretty much a clockwork machine at this point.
Yeah.
But to your point, right? Obviously, single family business, as you're growing, it's a ton of work. Like you're
Yeah.
acquiring every
Yeah.
single house one step at a time, you're
Yep.
fixing it up, leasing it, and things like that, right? And I did that, right?
Yeah.
So now I'm at a point where it is absolutely stable. We are just pretty much holding on and maintaining it. So I can see the benefits, but I can completely
Yeah.
sort of relay your sentiment there that yes, I mean, it is a lot of work, onesies,
Yeah.
twosies that you're doing, so many roofs, so much of maintenance and things like that, so many
Yeah.
leasing tenants. And as the game says, right, that multifamily, you come to a benefit of scales and things like that, right?
Yeah.
So there's definitely. So turning back to your story then, Dylan, here, what was that shift like? Why you wanted, yes, multifamily is a great way that I want to scale there and it makes sense to go there?
Yeah, I mean, that's a good question, right? So we all know, I think long-term wealth in this business is generated, in my opinion, through cash flow.
Sure.
I didn't want to wake up every morning and fix and flip another house, and I certainly didn't want to go back to building another single family portfolio.
Sure.
So I think the natural gravitation for me was, going into multifamily. And like many people, I kind of started with my own capital, and that only got me so far. And then I discovered, syndicating real estate, right?
Sure.
But I thought to myself, like you and I had just talked about, well, if I could get 100 properties, under one geographic location, under one roof per se, versus
Sure.
spread out throughout an entire state,
Sure.
mine weren't throughout the whole state, but a metropolitan area.
Sure.
That was very appealing to me. So that was my first goal. I bought, two 12-unit properties, and then a 96-unit property, and everything was great, right? So
Awesome.
my goal and my motivation there was I want to get back to cash flow. I want to have $1 million a year in cash flow. That was always my goal, right?
Sure.
And so I wanted to do that. And I'm always thinking about how can I simplify things? How can I simplify the process? How can I gravitate to the path of least resistance?
Sure.
And so for me, multifamily was it was a no-brainer in that capacity. And then I started to fall in love with it. And I said, all right, well, I only have so much cash and so much resources of my own. And then I stumbled across syndication and just exploded from there.
Awesome.
Yeah.
Now,
cash flow was the main reason. I wanted to get back to that cash flow, and I didn't want to do it with 100 properties spread across, a state or multiple states.
Sure. And you're absolutely right, Dylan, that there are just so many inefficiencies when it comes to when it comes to single family, I should say, that it's just not scalable, and some people don't have the luxury of, let's say, if someone is sitting in their car in, let's say, some of the, like banner markets of, let's say, the Charlottes or the Virginia or New York or Boston and things like that. They cannot say that, hey, I'm going to buy, let's say 10 single family houses in their close to their neighborhood. That sort of price to income ratio or price to rent ratio, as we say, it just doesn't work,
Right.
And you have to be in those right pockets to kind of get that proper cash flow and make it sort of a sustainable machine of sorts. And that's why I think we say that, yes, multifamily gives you that sort of scalability, efficiency, and of course the cash flow and things like that, right? So now today, Dylan, kindly share with us that where exactly, what states are your properties, and sort of are these B class, C class, or B plus properties?
Yeah. Good question. So early on, my focus was very much value add investor, right? And mostly for that cash flow, right? To build the cash flow. And my original objective, I'll kind of tell you how I've progressed. My original objective was to get into Class C properties and kind of Class B areas, right?
Sure.
Reposition those assets. And then, they were so distressed that we would, we're buying assets 1970s, 1980s. They're at the tail end. They need the renovations. They need everything.
Sure.
Reposition those. And then they were so distressed, we can improve value so much that we were able to refinance investors out in 12 to 24 months.
Awesome.
And then my strategy there was then we kept the properties in perpetuity in our portfolio, right?
Sure.
So we could refi, for people who are listening may not know, we could refi, return all the equity back plus a profit, which was tax-free for the investors, which was great.
Sure.
And then we kept it. And so that strategy worked really well. And then I kind of progressed from there, and I said, all right, well, my strategy shifted more towards wealth preservation at that point, which is kind of a whole nother strategy. Whereas before I was really much looking towards that cash on cash, 10, 12, 13, 14, 15% a year, was most important to me. I didn't really care about the value of the property at exit if it appreciated too much. But then what I found is it's like owning an old boat. And so sometimes we get into these assets in their 1970s and 1980s, and maybe their 1950s or 1930s, and they got 100-year foundations and you name it. And the operating expenses were running higher on these types of properties. And so as I started to progress again in my business, I said, well, look, I want to shift towards kind of buying assets which are Class B, Class A type of stuff that, is newer. We can hold maybe multi-generational wealth, where it wasn't so much cash flow, right?
Sure.
We were focused on. It was more like, how can we take money and how can we preserve that in these newer types of buildings? And so I kind of did that for about 2 years. And built a small portfolio there, placed a lot of equity there as well.
Sure.
For those who are listening, they might not know, my specialty is really raising capital through funds. So we have a lot of funds that are raised, and I deploy capital. We manage those funds as well. And then we obviously get a percentage of the equity of all that.
Sure.
So that was great. And then I said to myself, well, I'm still working too hard. I still don't like the process of finding, these buildings. And I don't like the process of managing these buildings and the whole charade. And so the last 2 years, like you and I had discussed, my focus really then gravitated even further to, all right, well, if we look at the capital stack of the equation and who's actually doing all the work, it's the syndicators. The syndicators are running around finding the deals and processing the deal and executing the value add strategy. And for me, it was very appealing to say, well, wait a minute, I have a lot of capital relationships, right? We've got capital ourselves that we're trying to preserve. I can earn similar returns and not have to do all the work if I just participate in the equity side of the structure.
Sure.
And so we've really shifted our business and our office towards really focusing now. We still syndicate, but it's stuff in, like you and I had talked about, it's markets where I like to be, because I want to have an asset that I can pop in and stay at. In Sedona, that's great. Or Naples, Florida, which I really enjoy, for example, is great, right? But now we've really taken ourselves and we're looking to align ourselves with good owner operators, good syndicators with proven track record that need that equity.
Sure.
And then look, my work goes down even more. I check in, make sure the plan's on track. I'm getting the returns that we're supposed to get. And I think a lot of people don't actually realize, and maybe you got an opinion on this yourself, but I can earn just as much in an LP position as if I were in the opposite position as the owner of the syndicate. I mean, it's just a matter of a few points. It's like nothing, and I don't have to do the work.
Sure.
And so that's really kind of where I've gravitated to now in a very short time, in a matter of like 5 or 6 years. So
Sure. And I echo that sentiment, Dylan, there as well, is that, and especially the market, the timing has to play, kind of goes hand in hand with that, is that, I mean, you and I both know that there are several markets where passive investors are making a ton of money that they can never complain about. And on the same token, you have sponsors who are also making equally good amount of money. And obviously rising tide lifts all boats, as we say, which is great. I mean, you would never complain that, hey, everybody exited, everybody's happy. You never have an issue, right? I mean, sure enough, if sponsor makes a little bit more money, I mean, that's what they work for, and that's the whole goal, right? So, and I totally echo your sentiment there, is that, yes, I mean, given the risk reward or the work that's involved, perhaps the passive investors are making, for a risk adjusted, they're making equally good money for sure, So now turning subjects a little bit now, Dylan, like obviously we're going through the pandemic and we know that so many jobs are affected. I mean, you have tenants who have sort of lost their jobs or reduced hours and things like that. So sort of that C-class is really kind of affected, right? So could you maybe share sort of, as we move through this COVID crisis, right? What sort of adjustments you are doing, whether it is looking at different class of deals or perhaps kind of maybe making some adjustments in your underwriting and things like that. How do you sort of piecemeal through all of this?
That's I'm actually, I was just reminded as you brought that up. I saw the writings on the wall. I'm a very analytical person. And if you're data driven, you can look at the markets and you can see how things shift. And on average, there's a peak and a low every 10 to 12 years, typically.
Sure.
Right.
Sure.
There's indicators in the market which you look for that there's possibly going to be a market correction. And so I saw the writings on the wall, and I knew sometime probably 2019, 2020. I didn't predict, the pandemic that we're in, but I knew something would happen.
Sure.
Real estate would shift. And so we liquidated out of all of our Class C assets. In 2018, we sold all of our positions and or all of the properties.
Incredible.
And for that reason, in anticipation, it was going to shift. And so I filled my portfolio back up with Class A, Class B types of assets ahead of that.
Sure.
And it's worked out very, very well. And that's why you've probably had many conversations with people in this. And I think every marketplace is different, by the way, how different classes have been affected.
Sure.
But, like in our marketplace, the people that are getting hit the hardest right now. Now, now let me say this. Residential real estate, multifamily, single family is still like very low, in my opinion, in terms of an asset class in real estate that's been affected by COVID, right?
Sure,
very stable. I haven't seen much of a ripple there at all.
Absolutely. We don't want to compare notes with, let's say, the retail or the transportation or hotel industry for that matter. But go ahead with your thought.
But then you break it down. So let's look at multifamily and say, okay, so what asset classes in multifamily have been affected? Well, I've seen people like in the Detroit marketplace, Class C, even Class D type of property is really being hit hard, to be honest.
Sure.
And that's not the same for every marketplace.
Sure.
So, to answer your question, we have had, just like you had mentioned ahead of this call, zero, knock on wood, zero effect.
Sure.
Nothing has, there hasn't even been a blip on the radar in terms of our tenants. But I think a lot of that is because of the asset class that we're invested in, the Class A, the Class B,
the
people that have the ability to work more remotely. When this thing first hit, a lot of people were getting affected in the Class C stuff because generally speaking, there were restaurant workers and this type of field that they had to be there, or they really got impacted by this. Retail workers, that type of stuff. Tenant.
Absolutely.
All, but just making a generalization here.
Typical blue collar worker, you would say, basically. Yep.
So, we were fortunate, and one of the reasons why I did so well in my single family portfolios, I really focused on, like you, buying in good neighborhoods, higher end areas.
Sure.
And I would have really good tenants, and I would never get a phone call, right? Because I would focus on people that would stay 2, 3, 4, 5 years, had good jobs. And so very similar to our multifamily portfolio is I want to be, I want to have a tenant base that is filled with, middle range to higher end type of tenants. Does that make sense?
It does. Absolutely. I mean, the portfolio performance is so much closely dictated to, sort of the class of your tenant, where they are working, what sort of their working attitude is, and how stable they are, and things like that. The lesser drama or the lesser volatility you can have, that's absolutely the key. Now, Dylan, you mentioned that your company has several funds and you're raising all sorts of capital, right?
Yeah.
Why are you kind of, sort of fund specific? Why not maybe perhaps do a asset specific, sort of syndications and things like that?
Well, that's a good question. And you had said this earlier. I do think that the love for funds, or the trend of, things move in trends. There's a time, if you look at real estate cycles, there's so many trends in like a 10-year period. And I think that there's times in which syndication works better than funds. There was a time in like the mid 2014, 2015 where people were like, no, if you have an asset, I'll invest in that. But funds were not at least my experience, funds were not very favorable during that time.
Sure. Mm-hmm.
And then when the market starts to crash and people realize, well, we want to have a little bit more cash, we want to be a little bit more liquid, well, the fund model starts to get more favored again.
Sure.
And so, early on in my career, I ran a very small venture capital company for 9 years in addition to real estate.
Mm-hmm.
And so the fund model was very natural to me. In 2008, 2009, coincidentally enough, when the market crashed, I launched my first fund. And it did very well because there was a need to be cash heavy. There was a need to be very liquid.
Sure.
And then that kind of phased out and was harder to raise funds. And then so I said, well, what do I do? And then I started going into syndications for a period of years, right?
Sure.
And that model worked very, very well. And now I just anticipated again, well, when the market crashes, when the market corrects, the lending starts to restrict, banks start to, those with cash are keen.
Sure.
And so I took 2019 off, and then I said, going into 2020, I'm going to go out of the gate hard and raise another fund. And usually they're like $30 to $50 million funds.
Sure.
I said, let's double down and do a $200 million fund because I know the market's going to correct.
Sure.
And this was like early, like December, just before the first of the year, right? And so we made a commitment to raise our I think it's our fourth fund now, $200 million fund instead of our normal 30 to 50 million.
Wow.
If for that reason, and then now look at things have happened. And I really think those who are sitting cash heavy, those who are very, very liquid are going to be in the positions of power, even over the banks, right? When the market shifts. Now, I do think these things happen personally in 12 to 24 month cycles if you follow it.
Sure.
I think a lot of people are still kind of confused because there hasn't been a shift in real estate per se. Things are still really nice. But I think it's also, there's been a time in history where we've never seen the government, we've never seen businesses get involved to try to prop things up and prevent a crash like they have today.
Sure.
Postponing foreclosures, postponing evictions, pumping a ton of money into the economy and that type of stuff. So I think it's kind of a false sense of security.
Sure.
It's inevitable at some point it's going to correct.
Sure.
But that correction is delayed. We don't know how it's going to play out.
Absolutely.
To answer your question, I think right now we're in a time where funds make a lot of sense. Syndications still make a lot of sense, but I want to be ahead of the curve, and I want to be sitting very, very cash heavy. And there's already a lot of syndicators, a lot of real estate owners that are in trouble. A lot of commercial real estate. I think the first time residential real estate got hit hard in 08, 09, this time around, commercial real estate is being annihilated. It's going to get hit hard, and it already is getting hit hard.
Absolutely. I think that tsunami for sure is coming. I mean, we can already tell. I mean, the restaurants, the strip shopping centers and whatnot. I mean, that's the cascading effect that perhaps is definitely on the cards. And as you alluded to, I think with the stimulus and all the stuff that's going around right now, we are kind of in that false sense of security, or hey, everything is good type of it's as we say, like it's the calm before the storm of sorts. So Dylan, kind of moving on in your fund model, obviously you are speaking to many passive investors and a lot of other folks as well. Can you maybe describe, like, let's say if you're talking to your potential passive investor, for example, how's that conversation goes? Like, what benefits you tell them, and how do you kind of sort of sell your product and convince them to invest?
Well, I mean, I've been doing it for a little while now, so I mean, naturally you have existing relationships, and you don't, I hate to say it, but it's always kind of this problem when you first start. It's like, it's so hard to get capital. And then at some point you have so much capital, you know what to do with. And I'm not saying that from an egotistical standpoint. It's just,
it's a fact.
These relationships take time. And so your job gets a lot easier over time, right? Sure. So very early on, we were very aggressive in how we structured our funds. Whereas now it's, we make very minimal effort, to be honest with you, in raising capital. And it depends on how much you're trying to raise. Sure. Because if you're trying to raise $200 million, like we suspect, we're going to have 4 institutional investors, probably at $50 million each. And when you're working with institutions, they have a lot more requirements. They want to see a lot different structures. They take a lot bigger piece of the pie. The reason why we've always done smaller funds in the past, the $20 to $30 million fund, because we could target high net worth individuals, family offices, in which we could maintain more control of the structure. We could charge, like some of our first funds, we offered I'll kind of tell you the progression. Some of the first few funds were you're a high net worth person, your family offices. A high net worth guy would usually put in 50, 100, 250,000. Your family offices would usually put in somewhere around 3, 4, 5 million. We'd have an 8% preferred return or a benchmark that had to get hit, a 2% management fee on capital deployed.
Sure.
Right. So not just, once we deploy it,
that's when the clock starts. Right. Sure.
We've experimented with the opposite where, okay, then it's just 2% on all capital raised so that we're not in a rush to deploy it, because that happens sometimes. And then it would be an 80-20 split over that benchmark. And that's most of our funds. Our fund today, there's no preferred return. And it's just an 80-20 split on all income that comes in.
Sure.
And the minimum investment we have so many spaces for kind of your high net worth guy. And the minimum investment there is $100,000.
Sure.
Most of the funds made up of family offices, in which the minimum investment is $3 million. And then our minimum institutional investment is $50 million. And there's 2% fee on capital managed, so not capital deployed. And again, it's just an 80-20 split on all income, no pref. So we've kind of gravitated, whereas before the pref really, really mattered to people. And as we were building our reputation and our background and performance, people felt a lot more comfortable with that. Okay, no matter what happens, these guys screwed up. There's at least this kind of benchmark, right? We're going to get paid the 8% first, assuming everything goes well, right? Which they did, thank God. But as we've gravitated now and we have existing relationships and people trust us, we've actually been able to eliminate that pref.
I see.
And we just go to a straight split. And we even do that on our syndications now. A lot of syndicators offer a preferred return. On our syndications now, it's just an 80-20 split on most of our deals. And if you really do the math and you model it out on a pro forma, this is actually very interesting. We find that just a straight split, an 80-20 or 70-30 or whatever, is actually better return-wise for investors than offering a preferred return, if you actually do the math and model it out on most deals. I don't think a lot of people think about that.
Sure. And there's something to be said about investor psychology there as well, that some people feel that there's safety and comfort in having a preferred return. And as you and I both know, that both models are viable, and many large syndicators and large offices just do a straight split. So there's definitely sort of a place for both of them. And I mean, there's no right or wrong. It's just that what suits the peace of mind for an investor, whether it's the pref return, and that's what they gravitate towards. So all things are good. Now, so I appreciate all the detail there, Dylan. Thank you for that. And if speaking of your progression from, let's say, a smaller fund to a 30 million to now, let's say, the $200 million funds, Dylan, you went through a gamut of, talking to like friends and family, then perhaps your typical high net worth accredited investors, then you mentioned family offices, institutional money, and things like that. Kind of walk us through that progression, if you can, please, for our listeners. That would be an interesting conversation for folks to listen to, that, how much time it took, or perhaps what goes behind the scenes about, let's say, whether it's marketing or, kind of reaching out, and kind of, sort of one step at a time, what it took. I mean, because I think you're going to family offices and institutional money. I mean, you are kind of pretty much in the big leagues of, all the private equity that's perhaps out there. And I think, and let's lay it down that a $200 million fund creation, and as young as you are, and you are at that stage, is a phenomenal achievement. I want to definitely congratulate you for that as well. So walk us through that progression, if you can, please.
Congratulate me when we're done. We're only about a third of the way through, so.
Sure. But we are way there. I mean, absolutely. I mean, you are way there.
We've got 12 months, so.
Sure.
But thank you. So, it really depends on your strategy. And this is, I actually have a really good video I shot on this on my YouTube channel.
Okay.
It talks about raising private equity, and then you kind of look at it as this toolbox, and like, what toolbox do you tip in for what? So for example, when we're syndicating real estate and we're trying to raise, $3 million, and a syndicate, well, a lot of that is going to be your institution or your high net worth guy, maybe your guy with your 401k or IRA who's going to put in 25, 50, 100,000. But then you kind of reach this peak where you wouldn't raise a bunch of private individuals like that. You wouldn't raise 5 million because you could have 100 people in that syndication deal, right? So you kind of reach this. I've noticed kind of these peaks when it comes to capital raising. And 3 million, if you have conversations with family offices, is too small. Most family offices say, hey, don't call me unless it's, 3 million or above in equity.
Sure.
And so I've kind of, figured that out over the time, and it said, all right, so then I look at my deal and I let the deal dictate kind of which box I tap into, right?
Sure.
The same conversation goes with institutional investors. I have one institutional investor out of 1,100 contacts that says, I'll go as low as 25 million. Most tell me, don't call me unless you need a check for 100 million or above. Now that seems like a great problem to have, but there's not a lot of deals out there that require 100 million in equity.
Sure. You need a large portfolio to acquire. That's probably a large Class A portfolio. And
there's a handful that say kind of their baseline is 50 million, right? And so you got to let and by the way, it's like, you just have to let the deal dictate which box do you go into, which box do you tap into, right?
Sure.
And so I look at that as I'm doing deals or I'm raising funds, and I say, very rarely do we get in a position where we have to raise institutional capital because we don't have deals that require 50 million, 100 million in equity, right?
Sure.
So I don't know if that answered your question or not, but
partly. I definitely appreciate it. But in terms of let's say the marketing or behind the scene mechanics of whether you're sending out mailers or attending conferences and things, if you can kind of give us that progression, I'd appreciate it.
Yeah. Well, there's different strategies for different categories, right? Sure. So as with I'm trying to raise from your high net worth guy, your guy who's going to put in some money from a 401k or IRA. What I found very well is what we call, magnetic capital. And I didn't coin that term. Somebody else came up with that. I just have adopted it. Magnetic capital, we're attracting it to us, right?
Sure.
And that strategy is very much educating the consumer. So I put out a lot of educational content. We have over 150 videos on our YouTube channel. I set up a landing page and I drive Facebook traffic to it and Google traffic to it. And I get a lot of people who come to me and they say, okay, Dylan, you're an expert, you're authority in this space. I've got 50 grand or I got 100 grand. And they actually fill out a lead form that says, I want to invest. And you can see this if you go to borlandcapital.com, you can see an example of this.
Sure.
And so if I'm trying to attract that type of equity, which is most people, right? Sure. That strategy works very well where I'm driving people to a landing page. They tell me exactly what their asset classes they're interested in, exactly how much they want to invest, exactly how soon they want to invest, and what types of returns they like to see. And they fill out this form, comes to me in an email, and I follow up. Now that relationship has changed. Instead of me prospecting and calling them, which by the way doesn't work well in raising capital.
Sure.
I'm responding to them and saying, hey, tell me more about this. And if I have a deal that fits within these parameters, how soon you're looking to invest? Well, I already know immediately.
Sure.
It just is a much better conversation. So that's kind of the strategy in that capacity. With the family offices, one of the things that has served me very well is I actually opened my own family office. I think it was 2017. Now, technically, they say most family offices start at like a $20 million net worth or above, right? And so I joined the network. I opened my own family office. We manage all of our stuff here internally as well. You know how family offices work. Sure. But that has opened up. It's kind of like a brothers club of other family offices. And by having my own family office, I'm immediately welcome as a family office kind of in that circle. And I'm
in that network.
Instantly, okay, we want to do deals together.
Sure. Instant credibility. Yep.
Yeah. Ahead of actually having my own family office, though, if I'm trying to raise capital with family offices, attending the conferences, Richard Wilson runs, in my opinion, the best family office conferences. He has like 30 events annually, and now they're doing virtual events, I think.
Sure.
And attending those and shaking hands and networking, and you can actually join their database and get list of all of these family offices, what they're allocating capital to, and then in that capacity, we'll mail to them and we'll physically call them. And it's not, hey, do you want to make an investment? I have a deal, which most people do. They just shove a deal down their throat and they blast that list and they kill the list. It's, hey, my name's Dylan. I'm doing whatever, and I want to see how can I serve you. What types of deals are you looking for? what types of opportunities and returns. And if there's something that I have that makes sense, would you mind if I reach out to you? I want to serve you. I'm at service to you, right?
Sure.
And so reaching out well ahead of the ask, in this space, especially with family offices, they say it's 2 years it takes to build that level of trust and that relationships. And I agree with that, right? And so you've got to start doing that work now. So now it's not so much about educating and attracting them to us. It's outreach. How can I be of service to you? How can I provide value to you? Let's build and maintain that relationship. Every time I'm in, I've got friends in California. Every time I'm in California, I'm stopping at one and having lunch or having a glass of wine or something. I don't drink wine, but they're having a glass of wine. I'm having water. Right? And maintaining those relationships over the course of 1 to 2 years, joining things like country clubs and private clubs. Like you see my shirt on now, I'm part of the athletic club, Detroit Athletic Club. I have a network of other private, emerald level clubs across the world that I can go to and network with high net individuals and other family offices and go play polo or something, right? Sure. And so those strategies work very well. And then from an institutional standpoint, I subscribe to a service called PSIonline.com. And it's a database of institutional investors, mostly pension funds and funds of funds and endowments and things like that. And they give you right there in that database all the fund managers, all the pension funds, who to contact. Are they allocating towards alternative investments, and how much of that is real estate? And then it's just reaching out to them. And there it's not a relationship thing, right? There it's what is your experience? What is your track record? And are you institutional worthy? Meaning, are you set up? Do you have a solid track record? Show me that you've managed $20 million in real estate. Show me that you're institutional quality, that you're audited every year by a third party. They want to see that you're institutional worthy and that you have a really solid track record in management and owning and managing this type of capital. And that, and I don't know how you accelerate that. For me, I wasn't able to tap into institutional capital until recently. And then the other way that you can do it, because now we have deployed 180 million in capital. Now I have 3 funds. I can say, here's the track record. But that took me raising capital first from private individuals and family offices. It was a progression. I think the way that you jump that hierarchy is like on our team now, we're raising 200 million. It's the same feedback. Well, show me you've managed 200 million. So I've brought people on my team from Wall Street. I brought people on my team in the private equity space that have raised $100 million and have that track record. So just like you would bring on a sponsor, I brought people on my team. Like I have another family office. They're $1 billion family office. Well, he's on my equity team for this fund. And we can say, here's my experience. And oh, by the way, they have $1 billion private portfolio and they're on our team as well too. Awesome. So that's how we've been able to jump kind of that hierarchy and transition to the $200 million space. Sure.
Absolutely. It's just like, how people build their credibility by having a lot many mentors and things like that.
Right.
So you partnered with the right set of folks who are higher and much above you and to kind of help you propel to your sort of achievement. Incredible story and incredible details there. I appreciate the detail there, Dylan. Thank you. Now, speaking of family offices, you said, Dylan, that you established your own family office that sort of got you in that sort of brotherhood network of other family offices as well. Can you maybe perhaps share how can someone get started with opening a family office as well? Because I think that your sort of your bellwether figure, you said 20 million, does ring a bell to, someone like me, for example, in all honesty I'm far beyond that. And I would be perhaps certainly be interested into exploring that as well.
Yeah. So, the family office, kind of environment is quite frankly, I think relatively new. There's not a lot of official framework around it. It's a space that's expanding and growing. Family offices for a long time, people with, maybe you sold a company and made $200 million, right? And they've, for many years, we've seen the trend of them not trusting putting their capital with your traditional financial advisor. So a lot of family offices kind of migrated and said, I'm going to bring in-house kind of somebody to manage my investments, oversee my investments. And this is kind of how it's progressed. Now it's transitioning into kind of an official thing from what I've seen. And there's seminars that support it and a framework that supports it. how do you make a family office? Well, look, you just go out and create an LLC. Generally, you're going to hire somebody to manage in all of your internal investments and portfolio and outreach and marketing for you and look at the deals for you and underwrite the deals for you. But like somebody like Richard, for example, he will actually form for you and his company an official kind of family office framework and do all of that for you. So there's people now that are managing those services. Like I've got a good friend of mine, he's a billionaire. And again, I introduced him to Richard, and Richard's going through and kind of organizing, what are some of the problems family offices have? And some of the things that you think about is kind of that generational success planning, right?
Sure.
Well, we've created all this wealth. These are the things that family offices are thinking about. And then if we, most generational wealth dies after the second year and even more after the third generation, right? And so how do we combat type of that stuff? And there's all this planning that goes into it. And I think Richard has some great resources. He's got free books that you can buy, that you can get, just pay the shipping. And they give you kind of these introduction on how do you create a family office, right?
Awesome.
And I don't think there's any official, but generally speaking, like I said, I think to be considered an official family office, like you want to have a net worth of 20 million or above. I don't know. That's just what we've been told. But there's not a lot to it. I mean, it's a business. Sure. And you've got people running that business for you, and that's it, man. And
I see.
I joined through Richard Wilson at the Family Office Club, and got in his database, got approved as a family office. They verify you and everything else.
Sure.
And like I said, that kind of opened. Now we get invited to private dinners and things like that with just other private family offices. That's really been opened up the floodgates there for sure.
Awesome. Thank you for sharing that detail. Now, Dylan, in your fund, you have such a large fund now, right? How are you managing the risk? Meaning, are you focused solely on multifamily, or do you sort of block and tackle with, let's say, a self-storage or let's say manufactured home parks or any other ventures for that matter?
Good question. I've always been extremely disciplined. I don't go outside of exactly what I want. And that's multifamily. I only invest in multifamily, and I'll look at very specific markets. And I have to have I have a whole set of criteria. You can actually see it if you go to our website, and you'll see review criteria and kind of what we look for. But I don't go outside of that ever. And the only thing I invest in is multifamily.
I see.
Yeah.
I see. Got it. Thank you. I appreciate it. And any parting words and a couple of last questions here, Dylan, as well, is that what is some of your best advice in terms of, obviously you came through a career now, Dylan, where, you're obviously coming from a hard work, single family background, went through multifamily succession. Now you're kind of in that private equity space.
Sure.
So you probably are somebody who has kind of a wide panorama of people you've met, right from, sort of the contractors, your tenants, and obviously you went through, now you're networking with a very different stage of folks as well. So given all of that, what are some of the pieces of advice that kind of sticks out in your head?
Well, the first thought that came to mind as you were talking about that is I meet a lot of people that always ask me, Dylan, should I go into multifamily or single family or private equity or whatever? And, where should I start first? And most people like me said, well, let me progress and start in single family and progress up. That's just kind of the natural thought pattern. It's easier, seemingly easier to get in. But I got to tell you, like the advice I give people now is, if you know you want to be in multifamily, go right to multifamily. If you know you want to be in private equity, go right to private equity. Because for me, I had to unlearn 3 times now habits that did not apply and did not complement each other in all of those categories. Single family, the way you talk and communicate is so different from the way you talk and communicate in multifamily and the way you talk and communicate in private equity. And I think that's very challenging. The hardest thing for anybody in life is to change habits. And so, I don't know if this is advice or not, but I think, if you're thinking about where do you want to start, just go there. And it's the same amount of time and energy. People don't realize this. Quite frankly, it's the same amount of time and energy, pretty close to raise a $30 million fund as it is to syndicate a $20 million deal.
Sure.
It's the same amount of time and energy to go out and syndicate a 100-unit apartment building as it is to fix and flip, a couple properties.
Absolutely,
Right?
absolutely. And a favorite poem that rings true to my ears also is that what you ask from your life is what you get. Whether you're
Yeah.
asking, sort of, let's say a single family or a multifamily, or in your case, as you're saying, like go bigger into the private equity.
Yeah.
Incredible advice, incredible advice. And now, Dylan, one last question here. As you progressed into various aspects in your career, what sort of patterns you see me in terms of what are some of the challenges and some patterns that you see that you are able to at your vantage position identify and say that, hey, I see this forming up and this is how you kind of block and tackle this thing. Could you maybe share some of the struggles and kind of how some of the strategies you kind of have worked for you?
Help me understand that a little bit better.
Meaning,
Yeah.
like, for example, let's say you are from single family to multifamily, and now you're into private equity space. So struggles can perhaps be, hey, perhaps my branding is not great, perhaps my marketing is not great, or perhaps the way I want to communicate, I want to refine my tone and language, or perhaps I want to improve my customer service. So I'm just kind of maybe putting words in your mouth, but if you can relate the sort of the tone of my question and maybe kind of give us some input about, what has been harder and perhaps how you kind of conquered that.
Yeah, well, I mean, I think in terms of harder, I don't think any of them are any harder. They're all very unique experiences, and in each category, you're going to have challenges that are normal for that category, right?
Sure.
For me, in the single family space, I realize it's a very high emotion space a lot of times, right? Which I was never really comfortable with. I never liked that. People kind of led more with their emotions than logic, right? And so that's kind of a trend that you see there in that space. And you have to really play into people in that. Things like NLP when you're selling people, and heavy selling and that type of stuff as you're communicating with sellers and agents. And then as you shift into the multifamily space, there's very little emotions, a lot of ego, but very little emotions and more logic, right? And so you have to learn how to communicate and look at things from a more logical, and people that really kind of excel in that space are people probably like you and I that are high analyticals. And then as you get into the private equity space, it's an entirely different ballgame where it's not even so much emotions as in logic as it is like experience, right? And so how do you get that? Well, I think like I said, you either bring on people that have the experience or you develop the experience yourself. And I think if I had to do it again, I'd probably go right to bringing on. That's the shortest path to success. Like you find a sponsor in a multifamily deal, right, to bring in people that have the experience. But I do say this, when we talk about trends and things that you see in real estate, I really want to, I call it my micro and my macro markets. And you notice no matter what type of real estate you're investing in, there's kind of this 10 to 12 year horizon in which things consistently go up and down. And you have to be very aware of what kind of, I call it my macro market you're in when it comes to investing. Like right now, if you're paying retail for stuff, you're an idiot. Right? Like, so because, you're paying the highest you're going to have for real estate. And so there's different strategies. And then there's kind of your micro markets, which to me are like the seasonal stuff. So like in Michigan, we have a lot of, we go through the seasons, a lot of states do. And so if I'm flipping a house and I'm planning to sell that house in January, but I'm using comps from the summer, right?
It's not going to work.
Then people aren't thinking about that. I might see a 10% dip in value, right? And so I really want to draw people's attention to, no matter what type of real estate you're investing on, be aware of how real estate is very kind of predictable. I mean, it happens, moves in these kind of big swings up and down, right? Like in some markets, foreclosures go really well and then they kind of dry up. And so what's the strategy right now? Well, right now, absentee homeowners is a great strategy if you're a single family guy, right? Airbnb owners is a great strategy. Coming up, there's going to be a lot of foreclosures that are taking place, right? And so these things and strategies shift, right? And the same with kind of the multifamily space as well, too. So I don't know, just when we're talking about trends, there's these kind of 10 to 12 year up and down, and how do you invest, and I think if you're buying value add real estate, you're going to always be fine. You're going to always be fine no matter what you're doing. If the people get hesitant and say, well, should I buy right now? We shouldn't buy if you're paying retail, but if you're paying at a discount to market value and there's significant value add you can add, you're going to be fine no matter what the market does.
Absolutely. Absolutely. Dylan, thank you, brother.
Sure.
I think I've thoroughly enjoyed the discussion. I'm sure our viewers and listeners will draw a ton of value.
Hopefully.
You know, your discussion about, sort of the financing, buying real estate at low, and if you're buying value add, you can never go wrong. Obviously, people have to understand what is a good debt, bad debt, and your whole notion about how the economy goes in cycles and the ebbs and flows, and understand that there are peaks and valleys, and be sort of a patient investor and make sure that you're buying correctly and things like that. Absolutely love that discussion.
Awesome,
Thank you for your time. Please share with the listeners how they can find you and learn more about your company.
You can't find me. I hide from everybody. No. Look, the easiest way is either dylanborland.com, D-Y-L-A-N, borland.com. You can get to all of my stuff from there, or borlandcapital.com, B-O-R-land, L-A-N-D.com. That's our private equity stuff. So
awesome.
Thanks so much for having me on, and hopefully somebody picked up one or two things they can, implement from this.
Absolutely. It's been a pleasure having you. For listeners and viewers of the podcast, please log on to premiumcashflow.com. We always have news articles and guest experts like Dylan who are sharing their wisdom. So a ton of value here. And if you're interested as well to invest, please log on and sign up. We can perhaps get on a short phone call and understand what your goals are, and if there is alignment, and we can help you with further. So thank you, Dylan. I appreciate it. And I look forward to having another thoughtful conversation with you in future as well. So.
Absolutely. Thanks so much.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.